Short-term rentals are a powerful tax strategy, but they're also a minefield. You have probably seen TikTok tax gurus and IG tax bros oversimplifying how short-term rentals work. And guess what? That is leading to massive increase in IRS audits. I have represented 3 clients with short-term rental audits in the last 6 months. Let's break this down the right way, backed by the actual tax code. But before we start, there's something important that I need to clarify. There's no mention of the short-term rental anywhere in the tax code. That's right. What we're really talking about is how the IRS classify rental activities under Internal Revenue Code Section 469. What does the tax code say? Section 469 limits how much you can deduct from passive activities. Most rental properties fall into this category because landlords don't materially participate, and that means their rental losses can't offset their other income. But there's one exception for short-term rentals. Let's look at this regulation. It states that if your average guest stay is 7 days or less, your rental activities are considered non-passive. That's huge because once your rental is classified as a non-passive, your losses are no longer restricted by passive activity loss limit and the IRC 469 I3A. Now, there's one more thing that you need to qualify for this tax advantage: material participation. This is very important. There are 7 material participations. You need to meet one of them to prove that you actually manage actively your rentals. For example, one of the tests says that if you spend 500 plus hours managing the property, you are materially participating. Another test says that if you spend 100 hours and more time than anyone else on the property, you qualify. The bottom line, tracking your hours is critical. If you can prove your material participation and your average guest stay is 7 days or less, your short-term rental losses can offset your other income like W-2 wages or business income. Let's talk about cost segregation, supercharging your tax savings. Now that your rental is classified as a non-passive, let's take it a step further with cost segregation. What is cost segregation? It is a strategy that accelerates depreciation so you can take a larger deduction up front instead of spreading them over 27 and a half years or 39 years. Here's how it works. A cost segregation study breaks down your property into different asset classes, allowing you to depreciate certain parts faster. Tax reform introduced bonus depreciation, which allows you to write off a larger portion of your rental property immediately. Boosted bonus depreciation to 100% until 2022, then gradually reduce it to 80% in 2023 and 60% to 2024. This means real cash is in your pocket today instead of waiting decades to claim deductions. Let's recap. Average guest stay must be 7 days or less. You must materially participate in the property. A cost segregation study accelerates your tax deductions. Bonus depreciation lets you take a huge upfront deduction. But here's the catch. This strategy is complex and must be correctly done to avoid any audit. If you want to maximize your tax savings the right way, let's talk. Call me at 1-866-907-1845. Let's build your tax strategy today.